Over the past year, it's fair to say there's been a lot of changes. From new prime ministers, new budgets, soaring inflation, and a huge drop in the markets. Off the back of this comes some important changes to investing that you need to be aware of in 2023 to make sure you're being as tax efficient as possible and maximising your returns. Today I'm going to run through these important changes and tell you exactly what you need to do for each. Okay, so the first change, and perhaps the most frustrating, is to dividends. The amount of income you'll be able to receive from dividends, which is tax-free, is decreasing. In the current tax year, it's still £2,000. In the next tax year, it will be £1,000, and the year after, it will be down to a shocking £500. If you own shares in any company and receive a dividend, you'll be liable to pay this tax. I pay this tax, for example, being a director of my own company, so I'm already using up my allowance. If you go over that, you'll have to pay tax on those dividends. Kindly, they've decided to leave the rates the same instead of increasing them as they originally planned. Basic rate taxpayers will pay 8.75%, higher rate 33.75%, and additional rate will be paying a whopping 39.35%. It's definitely a play to hurt business owners. I think in particular it will hurt small business owners far more than larger ones. Now, one solution you may think here is to switch from an income fund to an accumulation one. Well, unfortunately, whether you're in an accumulation fund that automatically reinvests the dividends, rather than paying them out to you like you would an income fund, you're still liable for the same tax. HMRC describes it as, the reason for this treatment is to ensure that tax is not a factor which might distort investors' choices. It also prevents investors delaying payment of income tax through long-term accumulation of income. The second change, and perhaps the one that will have the biggest impact to us, is capital gains tax. This is essentially getting halved in the next few years. This year it's $12,300, next year it will be $6,000, and the following year $3,000. It's worth noting that this is doubled if you are in a couple. Capital gains tax is the amount of profit you're able to make from selling an asset without paying tax. This will primarily hit property investors and is likely to be another stab at abolishing landlords, as they seem to be set on doing. But it will also affect the tax you pay when you sell shares. Any profit you make over this, you'll be liable to pay 10% tax as a basic rate payer and 20% tax as a higher rate payer, which I find frustrating, especially with stocks, as you're taking the risk with your hard-earned money, which you've already paid tax on, to hopefully make a profit. You'll notice there's a huge gap between the higher rate tax on capital gains and dividends, 20% versus 33% or 39%, which is essentially there to stop people taking hefty dividends out of their companies at a lower tax rate. Whether this actually affects who they think it'll affect, i.e. the rich, I'm not convinced. So if we take both of those limits into consideration, if we assume we're going to get an 8% return, in this tax year you could have £154,000 invested without paying corporation tax. Plus, you could make your £2,000 a dividend without paying tax. Now, in the next year, you could have £75,000 invested and £1,000 in dividends. And the following year, only £37,500 and make £500 in dividends. Initially, you might think £154,000, that's insane. But when you notice it's dropping right down to £37,500, and when you consider you'll be investing for 10, 20 years or even more, that soon adds up to those sorts of numbers. Now, there's quite an obvious solution here, which you may have already spotted. If you invest within a stocks and shares ISA, a junior ISA, lifetime ISA, or a pension, the tax isn't applicable, which actually stresses how important these accounts now are. The downside is, actually, in terms of your tax-free allowance, it's just been cut quite significantly. Luckily, ISA limits remain untouched and you're still able to deposit $20,000 per year, which hopefully will last. But actually, as part of a long-term investing strategy, having a general investment account was quite important. Part of my own goal was to build up an account which would generate $12,300 per year, which I could take as income or use it to fill my ISA. Likewise, when you get to retirement, that was $12,300 plus $2,000, $14,300 that you could pull out as income each year. So while that might not seem like much of a blow now, it could be when you come to retire. If you have money in a regular account, you can also look at doing a bed and ISA, which essentially sells your assets from your regular account and rebuys them in your ISA. This is only available with certain providers, so you'll have to double check that they offer it. But accounts that you need to look at this year in order of importance are 1. A pension, 2. A lifetime ISA, and 3. Your general ISA. I feel like a lot of people are very set on building an ISA, which is fantastic. but pensions are amazing. 20 to 40% boost on everything you invest, and the Lifetime ISA gives you up to £1,000, 25% instantly for free each year. You have to look at these if you aren't already. And there's one more change I want to talk about, which you might not expect, and is weirdly something we've not been in a position to discuss for quite some years, and that is interest. With all of this dreaded inflation ongoing, the one good thing that's come out of it is interest rates are far higher than they've been for quite some time. Now you might think, well, how does that affect my investments? A well-balanced portfolio should hold quite a significant portion of it in cash. I'd argue at least 20%, so you have the ability to take advantage of times where good buying opportunities become available. In the past, because interest rates were so dire, it didn't really matter what you did with your cash. Stick it in an account and keep it until you're ready. But now that interest rates are actually half decent, you might want to rethink what you do with this cash, because a lot of investment accounts don't pay interest. Here's some interest I got the other day, which is quite amazing. It's the most I've ever received, and I'm only at 2.75%. Now don't get too excited, I'm in the higher rate this year, so I can only have £500 tax-free. But basic rate is still £1,000 tax-free in interest, and it's still worth considering. After that, you will pay tax as if it's your normal income. The only reason I have this in here and not invested is because it's for a house deposit in the next 6 months. So perhaps think about holding your money outside your investment account until you're ready to actually invest it. And definitely check with your provider what they're offering you. Vanguard actually offers quite good interest rates. It's currently 2.75, although they don't publicise it for some odd reason. You actually have to ask them about it. One consideration here also is if you have a SIPP, putting £1,000 is going to instantly give you £1,200, which is a 20% tax boost. Then if held as cash, you're going to get 2.75% on £1,200. So it may be worth thinking about starting your pension this year. I'll have some more content around pensions coming soon. I know on the surface of it some of this is quite boring, but I do feel it's very need to know and important you understand it in your investment strategy, because it could have some pretty huge implications. So it's really important to get right. I hope this was helpful. Let me know if you're taking advantage of any of these interest rates in the comments down below, as I think it would be super helpful to share what you're doing with others. And here is another video I think you might find really useful, and I will see you over there. Thanks.